Welcome, everyone. Thank you for joining us today for our State of the Market webinar. I'm Clayton Johnson with Squire Wealth Advisors, and today joining us we have Brian Haywood. Thank you, Brian, for joining us today.
My pleasure.
So let me introduce Brian. Brian is from Buckingham. We've been aligned and working with Buckingham for decades now. Brian is an investment advisor, takes pride in working in an industry where often driven by commission, not conscience, he and his team spend their time customizing portfolios for clients and upholding a fiduciary responsibility to those clients. I've had the privilege of attending many conferences and presentations where Brian has led discussions on investments and what's going on in the market. He truly knows what he's talking about. He's part of the Buckingham Firm's investment policy committee, so he's part of the team that's building portfolios and customizing and really working in the investing world. So Brian knows his stuff. So again, Brian, thank you so much for joining us.
Yeah, again, my pleasure, and looking forward to it. So if you want, I can jump right in, or
yeah. Let me just let the attendees know that there is a Q&A. So if you have questions while he's presenting, please enter those into the Q&A, and I'll be monitoring that. We've got a couple of members of our team monitoring that, and we'll present your questions, and then we'll save time at the end for additional Q&A. So if someone pops in right at the last minute, you can say, "Oh, there's time. Don't worry." So so Brian, please take it away, and go ahead.
All right, sounds good. Thank you very much. All right, can everybody see my screen? Does it look good, Clayton?
Yeah.
Perfect. Well, as Clayton alluded to, I'll be giving a state of the markets here. So as he said, if at any point you want to jump in with a question, don't hesitate to put those into the chat. With that said, in this particular presentation, I'm going to be discussing first a quick market update, an economic update, so just seeing where the US economy sits as of the end of Q3. Talk about the Fed policy shift we saw recently. So they finally began the process of recalibrating, as they called it, recalibrating rates. Talk about geopolitics and markets, as obviously we've got a pretty big election coming up here in about 3 weeks or so. And then obviously we have some geopolitical concerns with what's going on in the Middle East. And then the last two items, wanted to touch on two subjects that we have gotten a number of questions on over the past really couple of years. And that is, the first item is value stocks versus growth stocks. And the second one is international diversification. So I'll tackle those two kind of FAQs, my last two bullet points. So without further ado, what have the markets looked like in 2024? Well, as you can see by the a bunch of green on the screen here, markets have been very, very kind to us in 2024, not only in the US, but also internationally. So you can see through the end of the third quarter, the US stock market was up about almost 21%. Large value and small value stocks trailed a little bit, but still solidly positive. Looking at international markets, as you can see, international developed and international value and small value stocks all up a decent amount, although obviously international has trailed the US, but we've seen a little bit better value premium in the international markets relative to the US. And then last but certainly not least, we are looking at emerging market stocks have also produced very solid returns at up 17%. And then if you look down to the 1-year numbers, the trailing 12 months, really, really solid positive numbers. So it's been a very, very good 2024 for equities, basically across the globe. So hopefully, knock on wood, we can finish up 2024 with even better returns here in the fourth quarter. Now moving over to fixed income and alternatives, specifically real estate and commodities, you can see it's really been a great year for basically all asset classes. So U.S. fixed income is up about 4.5% this year. Treasuries, as measured by the intermediate portion of the curve, up about a little north of 4%. and then inflation protected bonds are up about 5% roughly. So good, strong returns from US fixed income. And then looking over to alternatives, global real estate has continued its comeback, up 13% this year and up a little north of 30% over the past 12 months. And commodities up about 6%. So really nothing too much to complain about in the capital markets, whether that be equities, fixed income, or some of our alternative asset classes. Really strong performance year to date through Q3. Now, turning our eyes to the U.S. economy, the first thing we look at, and obviously the lead headline of most economic stories over the past couple of years, has been, what has inflation been doing? And so what I've charted here is PCE inflation, and this is the Fed's preferred measure of inflation. And I've charted both headline and core. So the headline number is in the darker blue line, and the core number is in the lighter blue line. And just as a reminder, core excludes food and energy in that calculation. So you can see inflation has moderated significantly from kind of the highs in mid 2022 to a point where we're getting closer to the Fed's 2% target, but we're still a little bit above it. You can see there the headline number was 2.2% as of the last reading in August, and 2.7% if we're looking at the core number. So it's continued to come down, and we're getting closer, but we're still not quite at the Fed's bogey of 2%. Now, switching over to some other metrics regarding the U.S. economy. In the upper left-hand corner, we're looking at another inflation measure, CPI. This is probably the one that's more well-known and the one that's reported most in the financial media. And you can see they're a very similar story to what PCE inflation has been doing, moderating significantly since the beginning, mid 2022, to sit at about 2.5% today. So again, still slightly above the Fed's target, but we're getting there slowly but surely. Below that, taking a look at unemployment, we're still looking at a very benign unemployment rate at 4.2%. Now it has ticked up a little bit over the past few months. It's risen from about 3.8% up to about 4.2. So while 4.2 isn't overly concerning, it's certainly that upward trend is certainly something to keep an eye on, and I'll talk a little bit about that in context of the Fed decision here in my next section. But overall, unemployment is quite low. And in reading some literature, some of that is actually the labor participation rate has actually increased slightly. So it seems to be possibly some previously discouraged workers coming back into the labor force looking for work, which has ticked that number up slightly higher. But the good thing is we haven't seen a major uptick in layoffs. That would be one of the big kind of leading indicators that we could be headed towards a more rocky economic time or possibly recession. Switching over to real GDP growth in the upper right-hand corner, you can see real GDP growth has been strong. In Q2, it actually ticked up to 3%. So from a GDP perspective, we've continued to see the U.S. economy kind of show its strength. And looking at the data, we'd anticipate the the economy to remain somewhat strong, given the U.S. consumer still continues to spend. So we saw retail sales data that came out yesterday, or maybe it was the day before, that indicated strong retail sales growth. So the U.S. consumer continues to spend, and that's kind of what's been keeping the economy afloat, even though we've gone through this somewhat extended time period of higher rates. Now, one other area of minor concern is the monthly jobs report. As you can see, over the past year or so, we've started to see that tick a little lower. So the 3 month average has job growth is definitely come down. Although last print we got was 254,000, so it's still strongly positive. But that is an area of concern, seeing job growth begin to tail off a bit. I can't remember who I was talking to the other day, but they kind of phrased it as we're in an economy where companies aren't necessarily laying off workforce, but they aren't in a rush to hire new associates into their firms. Kind of a bit of a holding pattern here with rates still being a little elevated. So that is maybe a slight area of concern, along with the slight uptick in unemployment. But overall, looking at all of the data as a whole, the U.S. economy is holding up quite well to this point in time.
Hey, Brian.
Go ahead.
One of the questions that we'll often get and have ourselves, because it seems like the media talking heads bring this up, or they'll speak about the gloom and doom that's going to be forthcoming, and they make it sound like that's the same that's going to happen for the stock market. But we know that the economy and the market are really not married to each other. Can you speak a little bit to that idea of economy versus stock market, and just the concerns people may have if they say, "Oh no, the jobs report, there is some concern. Does that mean my portfolio is going to drop?" Can you speak to that idea a
Yeah,
little bit?
great question. While they are different, obviously they do affect each other. No question about that. But I think it's important to note that the market is one of the greatest mechanisms for digesting information. So the market, it's always important to note, is forward looking. It's taking into account all available data and obviously forecasting what that data means for the various companies that make up the market. So the market is already digested a lot of this data, because let's be honest, a lot of this data, when it comes to economic data, is backwards looking. And so the market in many cases already has a good estimate of where this data is going to kind of come in. It's really when you have surprises that might affect the market a little bit. But overall, I'd say the biggest difference here is when you get good or bad economic data, frequently the market already knows about this or has already kind of anticipated that poor data. It's sometimes there's a surprise, don't get me wrong, but for the most part, a lot of the time the market has already digested a lot of this information already.
That's perfect. Thanks, Brian.
No problem. Now, moving forward to Fed policy, last month, on basically 1 month to the day, if I remember correctly, it was on September 18th. The Fed actually, and this is actually a good segue, because although the Fed lowered the interest rates 50 basis points to a range of 4.75 to 5, the market had already kind of priced a heck of a lot of this in. So moving into the meeting, the Fed had already basically, or the market had already basically priced in the fact that the Fed was going to lower interest rates, and it was more of a question of just how much. And so they already knew they were going to at least get 25 basis points, and it was, kind of 60-40 whether they would do an additional 50. And the Fed gave us 50 basis points. So maybe slightly surprising, but not much. And you can kind of see that if you look at what rates did that day when they announced, they didn't really do much, because the Fed, basically the market had kind of already priced in what the Fed was roughly going to do. Now, looking at their summary of economic projections, or what they refer to as their dot plot, that's basically a survey. They survey all the Fed governors and whatnot, and they just ask them where they anticipate economic numbers to be, where they anticipate the target rate to be, the Fed funds target rate to be. And looking at that data, the consensus is the Fed is expected to lower the target rate an additional 50 basis points by the end of this year. So looking at where kind of Fed funds futures are, which is a good way to gauge what the market's expecting the Fed to do. It's looking like we're going to get 25 basis points here in November, and then another 25 basis points at the Fed's final meeting in December. And then on the next slide, I'll show you a little bit more about the longer term projections. So in their statement, as well as Chairman Powell's press conference after the announcement, they noted that the labor market is cooled, which I showed in my earlier slides, and inflation has come down considerably. So we kind of saw that in the data, economic data we saw in the previous couple slides. They did acquire more confidence that inflation will continue to moderate, so they still believe that inflation will continue to fall towards their 2% target. But the biggest thing they stressed is they're not on a preset course. So they'll make decisions based off of new and incoming data, and they can make pivots based off of that data. So they're not married to, okay, this is our plan as of today, and we're just going to execute that come hell or high water. No, they're going to be very cognizant of what new data coming in looks like. Specifically, obviously, inflation still remains the big one, but also unemployment as well as jobs numbers. They'll continue to look at those. Now, we did get a number of questions, and rightfully so. Hey, we still have inflation above the 2% Fed target, yet they're comfortable lowering the target rate now. That seems counterintuitive. Wouldn't you want to keep the target rate where it is until inflation got down to 2%? And the reason they felt comfortable doing this, in my opinion, is there's a lag between when the Fed actually shifts monetary policy and when that starts actually affecting the real economy. And it varies, you know, it's not uniform. It takes 18 months for this to happen. It can vary a bit, anywhere from kind of 6 months to some people estimate it could take up to 2 years. And it seems like that lag is getting longer as we have moved from more of a manufacturing economy, which is more sensitive to interest rates, to a more service-based economy, which is less sensitive to interest rates. But my reading the tea leaves, they think the economy is likely to continue to weaken a bit, but it's going to take some time for these lower interest rates to start kind of reheating the economy. So they're hoping, hey, in the short term, when conditions are still tight, we should expect inflation to continue to move down and below the 2% target. But you know, the cuts that we're making now should start to reheat the economy and hopefully not tip us into recession at some point in the future. So they're trying to walk a knife edge of cutting enough to not get us into a recession, but also still trying to get inflation below 2% and achieve, you might have heard this term, the soft landing. That's what they're trying to achieve here. So yeah, that's essentially what the Fed's kind of trying to engineer. Now, taking a look at their longer term projections for the Fed funds target rate. As I alluded to, looking at another 50 basis points of reduction this year, and then in 2025, expecting to lower the target rate an additional 100 basis points, and then by 2026, cut it an additional 50 basis points. So we're at an effective Fed funds rate of about 2.9%, basically 2 years from now. Which would put that in a range of about 2.75 to 3%. That's kind of what they're targeting if everything goes according to what the Fed's expecting. What I can pretty much guarantee, though, is I would say it's probably unlikely to happen because it never works out according to plan. No matter how smart these guys are, markets do and economies do what they do, and it's really hard to predict those changes. So I can guarantee those will probably be wrong in some way, shape, or form, but that's the best estimate we have at the moment. So we would expect lower interest rates as we move forward. But again, it's important to note that all of this information is known by markets and is already being priced in right now. So trying to change your portfolio or shift it to try and get ahead of this is a bit of a fool's errand, because the only way you're going to get ahead of this is you have to think the Fed is wrong and interest rates are going to be higher or lower than kind of what they're projecting right here.
Hey, Brian, real quick,
Yep.
just to that point you made too. Yeah, you'd have needed this chart 2 years ago to really make good on this, right? This is
Exactly.
public information at this point.
Exactly.
So maybe this is the appropriate time to insert a question that we had an attendee submit to us, and that was what expectation we have for housing rates in the next year, maybe, because those are tied to this in some way. Can you speak to that?
Yeah, I mean, I can't give an exact estimate, because it's important to note that most mortgage rates are based off of the 10-year Treasury note, and the Fed doesn't really control how those longer term rates are affected. When they lower the target rate, they're really affecting kind of the short end of the curve. So it's tough to say exactly, but based off of what I'm seeing here, I would expect mortgage rates over the next year to probably be lower, but I can't say that with 100% confidence. But I would expect them to be lower, and that's one of the reasons kind of the Fed wanted to lower interest rates, is they did want to encourage more economic activity, part of that being heating up the housing market a bit. So yeah, I would expect it to be lower. What it's going to look like exactly, I hate to give an exact number, because it's just a guess.
Sure. Yeah, I've had conversations with clients and friends who will delay making decisions because they hear about the Fed dropping rates, and so they think that there's a refinancing opportunity in the future, and then it doesn't actually happen, right? Or something's different. And so to add on to your advice, Brian, or your input, is proceed with caution when you try to anticipate or make predictions for the next year, the next 2 years, because of the point that you made a little while ago. These numbers are most likely going to be wrong in some way, shape, or form, right? And I believe we observed when the Fed dropped their rates, mortgage rates actually stayed the same or went a little bit higher, at least initially, right? And so it didn't behave exactly how everyone expected it to, and that's just the nature of the markets when you have so many transactions, so much information coming in all at once from different places. There's more than just the Fed rate that impacts mortgage rates.
Absolutely. All right. Transitioning into kind of geopolitics and markets, obviously, we've got a pretty tight election coming up here in a couple weeks, as well as obviously some geopolitical concerns with what's going on in the Middle East, as we've got both a war in Gaza and now potentially a larger conflict with Hezbollah in Beirut. So we don't know if that could potentially expand and maybe involve Iran to a degree. We'll see. Obviously, there's that could potentially happen, but I think it's important to note here that, speaking specifically to the first point about the election, there's really no discernible pattern as far as markets go when it comes to U.S. elections, and you'll see it in the next slide here what I mean by that. Now, while political developments can impact markets, it's important to note they're unpredictable. And so, trying to get ahead of these things is a bit of a fool's errand, as you're more likely to cause yourself more harm trying to get out in front of these than just staying diversified and living through them. So as it says in the third bullet point there, the most reliable risk mitigation tool is diversification. So be broadly diversified in your equity and your fixed income portfolio, and that's the most important thing to do. And as best you can, stick to your long-term plans regardless of what happens on November 5th. Okay. Looking here at the next slide, you can see here, this is a great slide that Dimensional put together. And you can see going back to 26, obviously we've had a number of different administrations, both Republican and Democrat, and the market, regardless of who's in the White House, tends to go up. So there's no, if you can spot a pattern in there that equity markets do better or worse under certain administrations, I'm all ears. But to me, that's a pretty strong trend that they just tend to appreciate no matter who's in the White House over the long term. So trying to estimate what a Harris win or a Trump win would mean for your portfolio, just please don't do that. Please don't try and mess with your portfolio based off of that, because there's whoever gets into the White House, markets are still likely to appreciate.
And then, Brian, can I add
to
that real quick, if you wouldn't mind going back to that slide as well? And I think this, you're probably familiar with this study. I recently read this study that was talking about which political party an investor is and how their performs during that president's period, right? And the research suggests that if you're a Democrat, then you perform worse during a Republican-controlled Congress and president. Is that correct, Brian? And then vice versa is true as well. And it's more, it's because of our behavior in the markets. When we're a Republican and a Democrat's in office, we think that the market's going to do poorly. If we're a Democrat and a Republican is in office, we think the market is going to perform poorly, and therefore we make decisions in our portfolio that are to our own detriment. And so just want to add validation to what Brian said there, is stick to the long-term plan. The market does not have a political party. The market is not red. The market is not blue. The market does what the market does. And this really answered some of the big questions we had coming into this state of the market. This is a big thing coming up. And I maybe you can speak to this, Brian, a little bit as far as short-term impact. We're not suggesting that there's not going to be short-term fluctuations come November, because we see that. I don't know if you're planning to mention anything about that, Brian, but do you have anything to add to that as far as short-term volatility, perhaps in the next month or two that we may see?
There definitely could be some short-term volatility. And remember, the presidential election is just one election that is occurring. The entirety of the U.S. House is up for election, obviously every 2 years. And then, we're still vying for control of the U.S. Senate, as that was basically, if I remember correctly, it's currently 50-50, I think, or maybe 51-49. I can't remember the exact breakdown. So, even if, Trump would win and the Democrats would control the Congress, that's very different than if one party controls, both branches there. So there's other inputs there. So if you're just trading on just the presidential election, that's just one input in many inputs there that could have short-term ramifications. But again, these impacts are not predictable. That's the biggest issue. So trying to get out ahead of these is a fool's errand, because you're going to, possibly You're going to pay taxes. If you start to mess with your portfolio, you could incur taxes that you didn't necessarily need to. You could be on the wrong side. If you anticipate one thing happening and the opposite happens, obviously you could have a poor return from that perspective. So it's just really important to take a long-term view that these events are random. They're very hard to predict. And even the best money managers out there can't reliably predict where markets are going, whether that be because of political events or geopolitical geopolitics or whatever it might be. These events are so hard to predict, and you're likely to cost yourself more money trying to get out in front of them than just sticking with the plan and writing it out. Specifically to that, I mean, look at we've charted basically the world markets here, and you can see all of the various crises that we've had going back to 1970, where those be oil embargoes. We had Black Monday there back in '87, which is crazy to see. Like the U.S. market, the Dow Jones Industrial, if I remember correctly, was down about 25% in one day, or 20%, something like that. And look at it on the chart here. Like it's barely a little blip on the radar here, some almost 40 years later. So you can see throughout all these various unpredictable events, the markets still at the end of the day go up. So it's important to have that long-term vision and that long-term view of things, and to stick with it. Don't try and time these things. Don't try and mess with your portfolio, because you're going to end up costing yourself more money in the long run trying to predict these events and trying to get out ahead of these shocks than you would have ever incurred just writing it out.
Yeah, that's great. Thanks, Brian.
Yeah, no problem. Now, last but certainly not least, these last two kind of bullet points I'm going to talk through are first, value versus growth, and then secondly, international diversification. Is within our portfolio specifically, we've gotten a number of questions on these two specific topics. So just as a refresher, when it comes to kind of value versus growth, it's important to remember that in the majority of our portfolios, we are tilting them a degree towards value stocks. And when we say value stocks, what do we mean? What we mean by that is stocks that have low prices relative to their intrinsic or book value. And then on the opposite, growth stocks are stocks with high prices relative to their book value. And the reason we tilt our portfolios a little more towards value stocks, and again, it's not that we don't own growth stocks, we just own them in a smaller proportion than the market does. And the reason we do that, as well as the reason we target small cap stocks as well, as you can see here, going back almost 100 years, back to 1927, on average, value stocks have outperformed growth stocks by about 4% per year. Now, that's an average. It doesn't work every single year. And I'll show you, recently, we've been going through a pretty rough period for value. Same thing with small cap stocks or the size premium. Small cap stocks have outperformed large cap stocks by about 3% per year. So that's kind of the historical data and the reasoning behind why we tilt our portfolios towards small cap and value stocks. Now, speaking to the performance of those premiums, specifically the value premium recently, what we've charted here is that value premium, not only in the US, but also internationally, going back to 2001. And you can see the 2000s, especially the early 2000s, were a pretty good year for value stocks, not only in the US, but also internationally. But fast forward to 2017, you can see there from 2017 through 2020, it was a really rough go for value stocks within the US. In fact, it was historically the worst drawdown we've ever seen for value stocks in history. Now, they did recover a bit in 21 and 22, but you can see, unfortunately, the tide has shifted again. It was negative in 23 and is negative again in 2024, although the third quarter was really, really good for value stocks, specifically in the US here. Now, international during that time period has fared a little bit better, but still underperformed. Just to kind of put this a little more in context, what I've done here is I've graphed the growth of a dollar invested in the S&P 500, which you can kind of think of as in the US as large cap growth stocks. And then the lighter blue line is Russell 2000 value stocks. So think of those as your, in the US, as your small cap value stocks. And you can kind of see starting in January of 2017, you're basically kind of right on top of each other. And then since then, you've seen a pretty big divergence in returns to the point where a dollar invested in 2013 has grown to $5 if you would have invested in the S&P 500 versus about $2.80 in value stocks. So, you know, it's no sugarcoating. It's been a rough go for value recently. So the natural question we're getting from investors is, should we continue to allocate to value stocks when they've underperformed by such a wide margin over the past few years? Now, while I can't say anything, nor can anybody say anything definitively about what's going to happen moving forward, there are some things we can look at to get an estimate of what we can expect moving forward. And the first thing we can look at, or I should say the main thing we can look at, is valuations. And so when we say valuations, the primary thing when evaluating the price of a stock is to look at the PE ratio, or the price to earnings ratio. So essentially, how much are you paying for each dollar of earnings that company is making? So what we've done here is we've taken the PE ratio for US stocks versus the PE ratio for small value stocks. So that ratio between the two. So you see, on average, going back to 75, you know, the US market had the ratio between US stocks as a whole and small value stocks been around, you know, let's call it 1 to 1.5%, or 1 to 1.5 times historically. What's happened though recently with the huge run up specifically in kind of large cap growth stocks is you can see as of the middle of this year, that ratio is really blown out. So US stocks as a whole are really, really highly appreciated relative to US value stocks. So moving forward, we would say there's typically regression to the mean. So, you know, take for example what happened during the dot-com bubble. You saw a very similar pattern where you had US stocks as a whole become very, very highly valued relative to small cap value stocks. And what did you see after that bubble burst? You can see the ratio went back to kind of its historical average. You know, value stocks, you saw those in the early 2000s when I was graphing out charting the value premiums. The early 2000s were a great period for small cap value stocks. Well, we would expect that given history, given the fact that the US market is so highly appreciated versus small cap value stocks. You know, it's hard to envision valuations continuing to get so out of whack and value stocks continuing to underperform. So looking at that, we have higher expectations for returns in the small value space versus the US market. And we eat our own cooking here. So if you look at our capital market assumptions, which are data we use to as inputs in all of our planning software, we are forecasting higher returns in the small value space than we're looking at in the US market overall. One thing to kind of drive that point home is this piece that AQR did last year. And AQR is a money manager out of Connecticut that we use a couple of their different strategies. And what they did is they decomposed the returns of the S&P 500. They did it over since World War II, And then they also looked at the past 10 years. Now you can see their data ended in 2023, but you can, the story is still the same because US stocks are still highly appreciated. So you can see, historically speaking, the S&P 500 has given us a real excess return over cash of about 7.1% on average. Now, looking at the components of that return, about 3.4% came from dividends, 2.6% came from real earnings growth, so companies growing their earnings, and then 1.8% came from multiple expansion, essentially stocks getting more expensive. Now, contrast that versus the last 10 years. We've gotten an excess return over cash of 11.9% on average per year over that 10-year time period versus the historical average of about 7.1%. So significant outlier there. Now, looking at the components of that return, actually dividends account for less, which is not surprising. If you look at the average company today, many fewer are paying dividends compared to where they were even 30, 40 years ago. The eye-opening things to me are 4.5% came from real earnings growth. So a significant increase in real earnings growth over that time period. I would say, given how much higher it is than the historical average, it's tough to envision a world where US companies can continue to grow earnings at that pace. That's crazy. That you're getting close to double the historical average there. And then if you look at multiple expansion, that is literally double what has happened historically. So you've had a period of really high earnings growth along with company stock prices getting significantly more expensive. That just doesn't seem sustainable over the long term. And I think the more interesting thing in this piece is they looked at, okay, to get another 10-year period like we just got, what do real earnings growth and multiple expansion have to do to get that? So just picking a specific point here, to get another 11.9% 10-year period, even if real earnings growth was 6% real earnings growth, which is nuts. That is 2.5x what we've gotten historically. Even at that insane earnings level, we would have to see multiples expand or PE ratios expand to 51. Right now, they're hovering around 30. And the all-time high was 44. So to get another 10-year period, we'd have to get not only insane real earnings growth, we'd have to get insane multiple expansion. Now, I can't say definitively that's not going to happen, but I would bet heavily we're not going to see that. And then if you go down the scale, even if you got kind of more, historically speaking, more real earnings growth, more in line with what we've seen historically, if you got 2.5% real earnings growth, you'd have to see multiples expand to 61 to get that 11.9% excess return. That's just showing how rich the U.S. market has gotten, specifically the S&P 500. I really, looking at these numbers, that was a real eye-opener for me, just how crazy expensive the S&P 500 is and how unlikely that type of return is moving forward. I would say there's a high likelihood that we're going to see lower returns from the S&P 500 moving forward relative to what we've seen over the last 10 years. And again, I think this is another kind of data point to show that we would expect US small value stocks, again, to have better returns, as they're pretty much right in line with their historical averages. And it's really kind of those large cap growth stocks, your typical Mag 7 names, NVIDIA, Meta, Microsoft, that have really kind of driven this ridiculous performance.
That's fascinating, Brian. Hey, we did have a question come in. My internet went out for a second, so I'm a little delayed in asking you this question.
No worries.
But the question is, have there been any studies that you are aware of on the impact of aging population on markets?
I have not really seen anything on that. Yeah, that is an interesting question, but I have not seen any, at least any recent studies on that. So I will have to reserve judgment on any, how an aging population would affect specifically the U.S. stock market. With that said, typically, the older you are, the less money you have in the stock market. So if anything, I would have expected a different story here. I would have expected, just given that if people are selling, if there's more selling of U.S. stocks because of an aging population, not only selling them to fund their lifestyle, but also just dialing back risk, I would have expected potentially lower returns in the U.S. And we've kind of seen the exact opposite. We've seen blowout returns from the U.S. But no, I haven't seen any specific studies that address that direct question, at least recent studies.
Okay, cool, thanks.
Yeah, no problem. Just to kind of drive this point home, I'll go over this slide really quickly. But what this is showing here is the total return over the next 5 years and then 10 years after significant drawdowns in the value premium. So what we've got here are the 5 largest. Now you can see the largest drawdown is TBD because we just lived through that and we don't have 5 years or 10 years of data post that drawdown. But you can see the other 4 there, we've seen a significant uptick in returns for value stocks. You can see there on the far right-hand side, the average annualized return for value stocks over the 5 years after a significant drawdown was almost 14%. So huge returns there. And over the next 10 years, it's been about 8.6%. So what you've typically seen after these big drawdowns is value stocks just shooting right back up and giving really outsized returns relative to their historical averages following these drawdowns. So again, kind of similar theme, stick with the plan and have a long-term view, as these value stocks tend to pop back up pretty quickly. Now, I want to get through this last section pretty quickly because I want to make sure we have enough time for some Q&A here at the end. But we're kind of getting some similar questions on the on international diversification, as U.S. stocks have produced, really outsized returns relative to international stocks. And naturally, a lot of investors have been asking us, should we continue to maintain a allocation to international stocks when U.S. stocks have done so well? And we'd first say, well, let's just take a look at the global stock market and see how much the U.S. and international represent. So you can see at the end of last year, U.S. stocks represented about 60% of the world market cap, and international stocks represented roughly 40%. Given the fact that international stocks represent such a huge portion of the world's market cap, it's hard to just say we're just going to basically completely ignore in our portfolios 40% of the world's stock market. That seems counterintuitive to me. You want diversification. You likely probably want to own some of those stocks, just given that they are such a massive portion of the global stock market. With that said, I also want to point out that long periods of outperformance by one of these markets, whether that be international or US, is not uncommon. So what we've graphed here are US stock, international stock returns by decade. And then that gray bar is the difference between the two. And when it's negative, that means international stocks outperform. When it's positive, that means US stocks outperform. You can see here actually from the 70s all throughout the 80s, actually international stocks outperformed US stocks. I'm in our St. Louis office, and we're actually moving offices here, so we're starting to pack up stuff. We'll have a new office space in January. And don't ask me why we had these, but we had some old money magazines from like the mid to late 80s. And they all of them kind of say basically the international markets are the hot place and that's where the future is, and that's where you should be investing. And the US markets are kind of these dinosaurs, and there should be less growth there. If you would have been paying attention to those magazines and shifted your allocation to international stocks, look what would have happened in the 90s. You would have gotten absolutely crushed as US stocks just blew it out of the water in the 1990s. They outperformed international stocks by over 11% per year. That's crazy, absolute insane growth. But then it flipped again in the 2000s, although, as you can see, the 2000s wasn't a great decade for equity investing as a whole. You can see international stocks did eke out a victory over US stocks, and then it's since flipped again in the 2010s, and it continues in the 2020s. So I just want to get across that this is not a completely a huge outlier, as this can happen from time to time, and we've seen it historically. It has been this way. And then last but certainly not least, again, just kind of looking at the valuation theme. If you look at the PE ratio for the US market versus international markets, you can see that ratio is higher than it has ever been historically. So US stocks are more highly appreciated relative to their international cohorts by the most that they've ever been, at least going back to the mid 70s. So I think that S&P 500, decomposition of return should really kind of drive home how insanely highly appreciated US stocks are. And so given these valuations, again, we would expect low returns from the US market relative to international stocks, as US stocks are so much more highly valued relative to their historical averages versus international stocks. The international stocks, as well as value stocks, they're all pretty much, their valuations are pretty much in line with kind of the long-term historical averages, whereas just kind of US stocks, specifically US growth stocks, are just so far above their historical PE ratios. So we would expect higher returns from the international markets. So again, stick to the plan, maintain the diversification. We anticipate that happening from international markets, but we don't know for sure. But you never know when these things are going to flip. And I want to make sure I have an allocation to international stocks when it does, because it is likely to happen at some point, and it could come back big time, kind of a la the 1990s in the US. That could definitely be could happen at some point in the future. So with that said, I'll turn it back over to Clayton for Q&A.
Okay, can you see my screen? Can you see the group? Hold on. Let me pull it up here. There we go. Okay. Well, Brian, thank you so much. This has been awesome. Want to give some time here for Q&A while we're waiting for maybe some questions to roll in. I wanted to just speak to that diversification that you'd mentioned, or when you showed that chart of international versus US. And what came to my mind, Brian, was this idea that if you're in a diversified portfolio, at any point, part of your portfolio is not performing well. That is really the goal of diversification, right? If you are highly concentrated in a single sector, a single stock, a single asset class, yeah, when that asset class is killing it, you're killing it. But when it's not, you're not. And so when you diversify, sure, it mutes the potential expected return, but it also mutes the potential downside, and you get more of that evened out. And in some cases, the diversification actually can enhance your returns over the long run, because the diversification does, I'll call it magic, right? It does some
Yeah.
great things to that expected outcome of your portfolio.
Yeah, that's exactly true. I mean, I think when I was talking with Larry a while back, I think he kind of mentioned this. It's when you have a diversified portfolio, you're always going to have FOMO. There's always
Yes.
going to be a bit of fear of missing out because, yeah, like you were saying, there's always going to be an asset class that is at the top and at the bottom. And if you're diversified, you're gonna own those and kind of
Mhm.
everything in between. And while yes, having those high returns are great, but also it's just as important as you were alluding to avoid those big negative numbers. So it's
Mhm.
it's also great that you only have a small percentage in that asset class that is really underperforming too. That's
Mhm.
also a good thing that it's not a huge portion of your portfolio as well.
Yeah, yeah, absolutely. Well, we haven't had any questions come in, so it sounds like you did so good, Brian, that you answered everyone's questions. Really appreciate your time, Brian, and for all of our attendees, we really appreciate everyone joining us today. And hope you all have a great weekend. Thank you, and thank you, Brian.
Yeah, thank you.